Have you ever invested in ETF but felt lost when the market suddenly changed? Not sure whether to hold, to buy more, or sell? You are not alone. So today, we will talk about how to handle your ETF investment in different market conditions so that you always know what to do next. To help you explore on this topic, we are honored to have Mr. George Paul, the co-founder of EECameron, who will show you how to navigate different market conditions and apply the right ETF strategies with confidence. Before we proceed, allow me to make a short disclaimer. Please be reminded that everything that shared in this session is mainly for educational purpose, and by no way that we are providing you any advice to buy or sell any securities. You are solely responsible for any investment decision you make. Now, let me introduce our guest speaker today, Mr. George Paul. Mr. George Paul is a financial practitioner and coach with over 13 years of investment experience and 5 years in wealth management and financial planning. He holds a Bachelor in Finance First Class from Coventry University, UK, and is a Certified Financial Planner (CFP) and Certified Member of FPAM. He is also a licensed under both the Securities Commission Malaysia and Bank Negara Malaysia. Beyond his professional work, George is the co-founder and host of Finance Lang, a finance digital media platform with over 2 million views and counting. He is also actively involved in organizing finance conference and workshop across Malaysia. With that being said, let us warmly welcome Mr. George Paul to the floor. Hi, Mr. George. How are you?
Hi, Stella. Hi, everybody. Good evening. Good evening. Right. Thanks for tuning in. Let me share my screen so that everybody can see it and we can start learning. Okay, all right. Can everybody see my screen?
Yes.
Okay. Right. Thanks, Stella. So, thank you everyone for tuning in. So today our topic is how to navigate the market cycles with Malaysia's ETF, and what are the strategies for different market conditions. Okay, let me skip all the disclaimers. Okay, now why these webinars today, what I'm going to share with you here is that ETF investing is not only about buying and holding blindly, because I believe most of you has heard about ETF, right? And ETF is just an investment tool, not different from stocks, properties, REITs, ETF. So these are just investment tools available for us. And the same ETF may behave differently in different markets. Like for example, different market environment and different, for example, bull market, bear market, and different market environment will affect our investor decisions. Because in, for example, current market condition, then what is the potential ETF selections that, or the strategies that you can use in terms of for you to structure into your investment portfolio. And what are the strategies that can help our investors use ETF with a clearer purpose? This is something that I wanted to share with you here. And last but not least, the goal is to move from product knowledge to strategy thinking. So my idea today here is to bring you beyond what ETF is, and how are we going to have an investor mindset that, okay, I can allocate my investment portfolio into some of the ETF in different markets. So this session is going to help you to think beyond products and the names of the products, just what kind of ETF we have available in Malaysia. And what this session is going to help you do, first of all, I'm going to help you to teach you how to read the market environment, because we need to understand how the market condition, the market directions, volatility, and also the sentiments will affect the ETF behavior. A different ETF, they will behave differently in different market conditions. Secondly, I will also teach you how to match the strategy to different conditions in the market. Like for example, what are strategy that we can use in bullish market, and what are the different strategies that we can use in bear market. And this is very important because we need to understand where the market is heading, and we can also match it with the available strategies that you have within your investment portfolio. Then last but not least is to build resilience for everybody here. And I will share with you for in the later part of our today's webinar to how are we going to use the core satellite thinking and to review our portfolio disciplinedly, and also to reduce the emotional mistake that we have during investment. And we are not here to help you how to predict the market, because we can't predict the market, but we can, throughout this webinar, we hope that we can give you some insights on how to make ETF decisions with a structure, right? And yeah, this is the learning outcomes. I will just quickly go through how to identify different market conditions, understand how conditions influence our ETF performance and strategy, apply the Malaysia ETF strategies more effectively, and build a resilient ETF portfolio and avoid some common ETF investing mistakes, right? Okay, now let me move on straight away into our first session of the day. Now, before I actually start all of this, right, can I ask all the participants here, what market condition do you think that our current market is? Let's just talk about Bursa Malaysia KLCI. In what market condition that you think that we are in right now? Are we in a bull market? Are we in a bear market? Are we in a sideways market or uncertain? Right? Okay. Somebody said bull market. Can I see some others? Do you guys have any idea of what market we are? Okay, somebody said we are sideways, uncertainty, right? Okay, a lot of you say uncertainty, sideways, right? Wow, that's quite a lot, right? Okay, now I'm not going to share with you what my what my take on current market condition, but I want to share with you that the same ETF can behave differently in different market condition, and market condition will change how us as investors use the same ETF, right? So ETF alone is not automatically good or bad, but their role will change depending on the market directions, volatility, and also our goal in investments, right? And here are the 4 market conditions that I wanted to share with you guys that you should be recognizing as well, right? So first of all, it's the bull market. Now, to keep things simple, right, I think I will just briefly tell you how bull market looks like. Okay, now I believe everyone of you here know. Okay, so bull market usually come with rising prices. Rising prices mean the stock price will raise, the index will rise, everything. And we see stronger confidence in the investor scenes. For example, you start to see your friends start talking about investment in stocks, in ETF, in index, and you will see a broader participation. What does it mean, broader participation? That means those friends maybe surrounding you that never invest in stock market before will start talking about stock investment, and that's where you see this is where bull market is, right? And everybody suddenly have a very higher risk appetite because everything is rising, right? And this is bull market. Now on the other hand, bear market is where the decline is, where the downtrend and the decline start forming, right? And usually during bear market, there is weak sentiment. That means, investors start to feel negative about the market. They start to worry about whether the market will keep on dropping tomorrow. And you will start to see a lot of investors start to, take profit or, reduce their portfolio position, in the stock market itself. So you will see a lot of people have a focus on capital protection during bear market because they don't know where the market will be tomorrow and the day after, right? And number 3, the third market conditions that we are also seeing is actually a sideways market. Now, sideways market means there is no strong trend whether we are going up or we are going down. So the price will move within a range, just like going sideways without going up or down. No clear sign whether the market will move upwards or downward, but the market still have to move somewhere, right? So it will move within a range, and this is what we call a sideways market. And last but not least is a volatile market. Okay, now what's the difference between volatile market versus bull market, bear market, and sideways market? Basically means the market is in high uncertainty, where you see sudden up and sudden drop. Now, this is what we call a large swings in the market. And usually during this market condition, you will see a higher emotional pressure because people don't really know what to, what to expect tomorrow. But the market still have to move anyway, and there is a lot more uncertainty that causes the sentiments to panic. One day you're very panicked, then you do panic sell, so the market starts to drop drastically. And one day you suddenly think, oh, the market is actually good. Then the second day you see the market rebounded again, right? So these are the 4 market conditions that I wanted to share with you. And after I share these 4 market conditions, let me ask you the same question that I asked just now before I am sharing. What do you think is our current market condition after I have shared with you these 4 market conditions? Are we in a bull market? Are we in a bear market? Are we in a sideways market, or are we in a volatile market? Okay. Right, I see a lot more of you are changing your answer to volatile market. Okay, some still remain at sideways market, right? And I can tell you, today's condition is a little bit different. We can't really say today we are at sideways or volatile market, because if we are looking at the index, you will notice that we are now at the bull market, where the indexes are rising, high rocketing. We are looking at S&P 500 breaking new high again and again, but the market uncertainty is there, right? So I would say we are rather in a volatile market, but the market's still on in a uptrend way. Now, don't ask me what's my take on the futures market trend, but I would say currently we are still at a volatile market, right? Now, let me go deep into how bull market looks like, and the different three different market conditions, right? So in bull market, it's always about, remember these keywords, growth, momentum, and confidence. So price tends to up and trend upwards over time. Investors are confident, risk appetite increases, more sectors may participate. That means we will see more sectors are in the uptrend as well. But in bull market, there are some risks that we need to be aware of as well, because we often see investor become too overconfident. When it is in the bull market, they are thinking, oh, the market will keep on, breaking new high tomorrow. So they are overconfident with the market, and some of the investors will come in late. They are chasing the late stage performance, and then they will get in at the very high, at the peak, and that's where the market start to turning down, right? And they are taking too much concentration, into the market itself. And one last thing, that the risk, and I think this is very important, for all the investors over here, and don't forget to do the downside planning. Because why that's important is because, when the market is trending up and is in a bull market, we always have we need to always have some backup plan, some standby contingency plan if the market start changing directions. Now, this is where, how the bull markets look like, and also what are the risks that a lot of investors they will make in the market. And bear market, on the other hand, is the opposite. So let me focus on the risk, because I think I have explained how the markets look like, in bull bear market. Now let me go on with the risk. Now, first of all, during bear market, and I can tell you, investors, we are emotionally attached to our portfolio and to the market. So when the market is in bull market, people tend to be more confident, and overconfidence will be the risk. While in bear market, people tend to over worry about what's going up, what's going on next. So investors will have panic selling, where you will start selling off all the positions, maybe at the bottom. That's where maybe the market bound, or we don't know, right? And some of the investors during the bear market, they will start abandoning their long-term plan. When they get in the market during the bull market, they say, okay, my planning for this portfolio is actually for my long term, for my next 5 to 10 years investment portfolio, for my futures goals. And suddenly, when the market is turning down into bear market, they started to abandon their long-term plans. Say, oh, you know what, I better don't invest into stock market anymore. So they exited their positions at the losses, and they stay out of the market. And that's where the risk come in, right? And a lot of investors also confusing the volatility with the permanent loss, because remember one thing, we are investing in the stock market, and volatility is always there. Because if the market don't have volatility, the market wouldn't move, right? So a lot of investors always think, oh, the market is too volatile, I don't like it. Then they cut losses, they do whatever they need to do to exit their positions, and that's what the risk is. And last but not least, not having a defensive structure on how to defend on our investment portfolio, right? And on the sideways market and also the volatile market, let me do a comparison here with you, right? In sideways market, we don't really see a clear upwards or downward trend. In volatile market, you will see a large price swing, and this is the big key difference of a sideways market and also a volatile market, right? So all good on the market conditions. Now let me move on to different markets require different behavior. Okay, what do I mean? So in bull market, investors often trapped with overconfidence. Now, how are we going to respond to this behavior? Be more participated in the market, but maintain discipline. Always understand that if the market is too, hype up today, it might drop tomorrow. So we need to always maintain our trading or investment discipline. And this is during the bear market, and it was very important. In bear market, on the other hand, people tend to be panicked, right? So what are we going to do to respond well to this market condition? Is always review our risk and avoid forced decisions, when the market is in bear market. And in sideways market, investors tend to be more impatient. They think that, oh, the market is not going anywhere, I'm not making money. So what are you going to do to be better investors? Is to stay selective and avoid over trading, because the market is not going anywhere, and it can go either way, at any point of time. So don't too too involved in the market, but stay selective to your investment portfolio. And last but not least is during volatile market, then investors tend to have overreactions. So what we're going to do is to focus more on our position fit and also our risk limits to make sure that we are not overexposed or underexposed our investment portfolio. Right? Clear, everybody? Okay, until here. Then next, I will move on to how Malaysia ETF actually behave across cycles. Okay, now, as I mentioned just now, we have 4 different market conditions. And in bull market, okay, what are the possible ETF behaviors the investor have is to benefit from the broader participation. Because I can tell you, during bull market, you will see a lot of the investment assets or index or sectors will turn upwards. And for us as investors, it's good that we have the market exposure to this market where it tend to move along with the market. Right? For example, let's say we are investing into our KLCI index, and when the market is in the bull run, KLCI index tend to move outward as well, right? Because that's how we explain whether are we in the bull market or bear market. So if we have exposure in, for example, the Malaysia KLCI index ETF, then you get to enjoy the market uptrend, right? And if the bull market is not only in Malaysia, it's a regional or it's a global thing, can we also, get some exposure or opportunities while trading the ETF in Malaysia, in Bursa Malaysia, while we have the overseas exposure? I will share with you some of the ETF available, on Bursa Malaysia, that we can also get exposure to overseas index or overseas stock markets, right? And that's very important. While in bear market, right, some usually overall markets will fall. And in this situation and in this market condition, diversification does not remove your market risk, because the overall market might be trend downwards as well. And what are you going to do during bear markets? Are you going to stay invested? Are you going to just keep on holding to your index ETF, for example, right? And sideways market, it may generate slower returns to us, but we need to always stay patient and review our discipline. And last but not least, during volatile market, okay, why are we going to use the ETF, to invest? Because if the market is volatile, maybe there will be some single stock risk available, to your portfolio. So how are you going to remove that? We can have some exposure, into the larger market or the index ETF, or whatnot, right? So I'm going to share with you later. And when we come to ETF, and one thing very important, when it comes to ETF, we tend to get a lot more selections or varieties. Not only in, for example, the KLCI index, but we get to choose different sectors, thematic ETF. So I mentioned just now, we have sectorial thematic ETF available, but okay, they are useful. Okay, don't get me wrong, they are useful, but they are not automatically safer because they are diversified. So we need to understand them and be more selective, when it comes to sectorial or thematic ETF. Now, why? First thing, because we tend to have higher cycle sensitivity. I'm just giving an example here. Like for example, there is this technology sector ETF. Okay, that they invest in all the technology stocks, available in Malaysia, for example, and if the market is not favorable for the technologies industry or sector, the entire ETF that you invest in will be very sensitive to this market negativity, because the entire ETF is focusing and concentrated into the technology industry. All right. Now, this is why we say a sectorial or thematic ETF, we need to be more selective, because they are having a higher sensitivity towards that, the market cycle. Okay. And of course, while highlighting the risk, this kind of ETF may also outperform, when the sector is good. For example, technology industry, again, that I mentioned just now, because we are seeing that the technology stocks, the AI, the semiconductors, they're driving the market right now. So if, for example, you get to invest into a technology sector ETF, then this ETF might have a higher chance to outperform the index. Right now, so this is the example. So they tend to have higher cycle sensitivity. And the second thing, we need to have a stronger conviction, because if we are going to invest into certain industry that's not belong to the general, overall market index, then we need to have a strong investment thesis of why I think this sector or this thematic ETF works in the current market condition, or it works well to your own investment portfolio. Now, that's very important. So we need to have a stronger conviction. And investors need to always understand the theme, all right, and also the concentration level behind the ETF itself. And last but not least, it is more important that we can view the sectorial or thematic ETF as a satellite tool. Now, what is satellite tools? I will share with you in the later part of the day of our webinar today, to understand more about the core satellite strategy, right? So to give you some hint of what satellite works, right, it actually to complement our portfolio, so that our portfolio have the exposure of potential upside, while we don't risk and the entire investment portfolio with over concentration to some certain sector or theme, right? And here are some common mistakes, that most of the ETF investors often they are overlooking at this thing. First of all, liquidity. Okay, can you enter and also exit the market efficiently? This is very important. Concentration, is the ETF too dependent on a few names in the market or a single team, investment teams that concentration risk that were available? Market exposure, does the ETF really match your intended exposure to the overall market, or to hedge or to protect against your investment portfolio, right? And number four, portfolio fit. Okay, does this ETF that you invested, right, duplicate or overload your existing holdings? So for example, your stock portfolio, right, in Malaysia, in Busan, Malaysia, just for example, you invest into all those KLCI blue chips company, right, the index constituent. And in ETF, you also invest into the KLCI ETF. Now, looking at this portfolio separately, you might not feel that this is something wrong. But if you view it together in the overall investment portfolio view, you will suddenly think that, hey, why I had the same exposure, towards the market while using different investment account, for example, right? So we need to always be aware with all these, things happening. So for example, if you already have, stock portfolio that is all the KLCI, or part of the KLCI index constituents, then maybe in your ETF portfolio you can try, to select those ETF that is not duplicating or overlapping with your existing holdings, and that's very important. And last but not least is the behavior risk. Will volatility cause you to abandon your investment strategy? And this is often, ignored by the ETF investors, right? With that being said, I'm going to share with you what are the ETF strategies for different market conditions. Okay, before I make clear, okay, to you what is the strategy to use in different market, right? And this is not a buy call, sell call for you, to go into the market right now at this moment of time. I'm just here to share with you some different strategies that you can think of and you can implement, during your, when you structure your investment portfolio. Okay. And this is for the bullish market. Now, when we are in a bullish market, always participate with a structure. Okay. Because a broader ETF exposure may help us participate in the market, but overconfident will tend to lose money for us. So what we're gonna do is that we need to always have a structure when it comes into a bullish market, and we can always position our ETF portfolio without over relying on stocks. Now this is something very good, but we need to always have a structure. Like for example, when the market is going to hype up, what I'm going to do, some take profit, what I'm going to, have some different exposure to, to reduce out my over concentration risk and whatnot. This is very important. Secondly, avoid overextensions, because like I mentioned just now, bull market can make investors overconfident. So we need to always look up at our investment portfolio and make sure we keep the concentration diversified. Don't do concentration into a single market that will have a risk towards the entire portfolio. And last but not least, always plan before the euphoria. So always decide, review, and also rebalance your portfolio before the market becomes too emotional that it will go out of control. Right? Now, this is the strategic thinking that how investors we might think, or we should think, when the environment is supportive, like bull market. And what about the uncertainty market, or the market is in bearish, right? First of all, we need to think in this way to reduce unnecessary concentration. Okay, review whether our portfolio is too dependent on one theme, one sector, or a single market directions. Review it and to reduce the unnecessary concentration to that market. And secondly, focus on resilience. Now, a defensive thinking is not same as exiting everything. So during uncertain or bear market, we need to always review back our investment portfolio and make sure that they are resilient enough to stay throughout the bear market or the uncertain market. Okay, if you found out that, okay, no, my portfolio, may have too concentrated into for example, a high risk growth market, then you might want to, do some rebalancing before the market get even worse, in the next maybe 3 to 6 months and beyond that, right? And last but not least, during the uncertain and bear market, always keep flexibility. Okay, what does it mean? Avoid forced decision. Okay, don't do panic selling. Okay, and don't get in the market too early. Keep your portfolio aligned with your goals and also your risk tolerance. Okay, and I believe with this strategic thinking, it might help you to move from emotional selling to strategic review. And always be reminded that uncertainty is actually a time for us to reassess our structure, right? And this is very important. Okay, now, how to think about pullbacks more constructively. Okay, now, is it normal? Okay, this is 4 steps for you guys to understand better. First of all, ask yourself, is it a normal pullback in the market, or this is a deeper trend change? This is when the market start to switch, right? You ask yourself, is it a normal pullback? If you think that no, this is not a normal pullback, the market might start to change the way from bull to bear, then that's where we review our portfolio. Okay, check your own investment portfolio. Are we still fit to the objective and also the time frame if the market have a deeper trend change? Okay, thirdly, layer. Okay, try to think of your investment portfolio or the strategy not with all or nothing decisions. What does it mean? Don't come in looking at your investment portfolio and think that, okay, the market is going bear market tomorrow, sell everything. And this might be one of the position that you took, and then you will regret once the market starts rebounded, right? So don't and please avoid this kind of all or nothing decisions, and don't tell them, okay, if not exit the entire position, I remain remain invested throughout the market in the bear market. So don't do that, right? And last but not least, always have control. Avoid reacting purely from fear or FOMO. And this is very important. And I think I have explained this many times, throughout the webinar here. Okay, now, how to manage sideways market or range bound markets, right? And I can tell you, sideways markets is actually psychologically difficult to trade or invest because you will think that all the strategies might not work during sideways market because the market is not going up or not going down. It's neither way, right? So you don't know, and all the strategies you use, right, you might see, hey, it's not work out well in this market. So a lot of investors, their mistake will be to over activity, to have more activities during this sideways market, but there's no clear signals whether the market will go up or down. So during this market, what usually will happen, right? You will start to feel, the returns it's very slow. You start to get bored. Then you will do frequent switching. Okay, but what is a better behavior if we are experiencing in a sideways or range bound markets? Always stay selective, like I mentioned just now. Avoid over trading because the market is not going anywhere, right? And be patient with the strategy. Okay, be patient with the strategy because over time, your strategy will work when the market have a clear signal of whether they are going up or they are going down. Okay, now with that being said, right, I'm going to share with you how different Malaysia ETF may play their different roles in different market in Malaysia. Okay, bear with me because I understand that if I give you all these ETF code, you don't really know what is this, right? But let me just explain to you. If we are in the bullish market, okay, we can have what are the ETF that may be more relevant to this kind of market condition? We might have our index, okay, and let me just give you some of the name here. For example, the China 100 MYR. So that one is ETF where have involvement into the China market, right? And for example, if we are in bear market or uncertain market, what are the ETF available in Malaysia that we can do, that might be relevant to this market condition. So you will see there is a dividend ETF. There might be gold ETF, And if we are in a tactical or you want some advanced strategy, then we have a 2-time leverage or inverse ETF available as well in Malaysia. Now I understand all these code might look stranger to you, and here's the ETF that are available in Malaysia. Okay, now we have bond index fund ETF, bond fixed income ETF. They invested, looking at the Malaysian bonds, tracking on it. We have a China ETF that they track the 50 largest and most liquid Chinese stock listed on Hong Kong Stock Exchange. We have the new China tracker that track the new China sectors, X A shares. So X A shares mean those that are not listed on China market. And we also get some exposure. For example, you want some Dow Jones exposure. That's where it is index that consists 25 largest Sharia compliant listed company on Bursa Malaysia. Now, this is where we get to have some exposure. Not only Malaysia, but we get to have some China exposure as well, right? And next slide, we have the Sharia compliant ETF, where you will see some gold ETF here. You have the US market, we have the Southeast Asia market, we have Islamic dividend counters involvement as well. These are the different varieties of ETF available. And the last page here is to showcase to you that we are not only having all normal ETF, but we also have leverage and inverse ETF as well. Now, for example, the KLCI2XL, this is a daily 2-time leverage ETF on KLCI. But on the other hand, we do have this KLCI1XI. This is an inverse ETF 1-time on the daily KLCI. And these are different available ETF in Malaysia that we can learn and we can study, right? And let me move on to how to build a more resilient ETF portfolio. And I think this is something that you guys are waiting for, right? And this is what I call the core and satellite ETF approach. Okay, so what is a core holdings, right? A core exposure. So in a portfolio, okay, a core strategy means it is designed to anchor the entire portfolio. So it's typically it's broader, diversified, or a more stabilizing exposures to the market. For example, the broader KLCI, for example, a broader KLCI, a broader China market, for example. This is where the core market is. It's more stable and it's broader and it's diversified. But on the other hand, the all four square you will see over here, the growth theme, the defensive role, diversifier, tactical ideas, and these are what we call a satellite approach. These satellite holdings used to express selective views. So for example, you have your core you have your core portfolio ready. While, for example, you think, okay, now we are in the bull market, then you can have some satellite exposure into the growth theme. Maybe you think, okay, now growth, then maybe I can invest into the China market, Southeast Asia market. Now, these are the things that we can choose. Well, for example, if you think, oh, the market now is in the bear market, I need to be more defensive, then you can switch your ETF holding, from the growth theme to, for example, dividends index, for example, bond index fund, ETF. And these are the example of how satellite and the core approach works well in our portfolio. And always think in the portfolio perspective. Don't think as, oh, this is KLCI index ETF. This is China ETF. Now I allocate this and that, into my portfolio. Don't think that way, right? I prefer you guys to think in a portfolio standpoint on a core and also a satellite approach. They will be more suitable to you guys, right? And yeah, think of their roles now. What ETF suit well in growth market? Which one works well in bear market? Which one have more diversification role into my portfolio? And if you need some tactical role, for example, the leverage and inverse ETF, these are the names that we can use, during the structuring of our investment portfolio, and it's very important, right? And now, I, with that being said, right, I've already helped you guys to categorize, some are the Malaysian ETF by their portfolio roles, just to give you some reference and um, to understand better. If, for example, you're looking for growth role in your ETF portfolio, maybe you can look at the China ETF, the US 50, for example. And if you are looking at more defensive role, then the bond fund index, the ETF. Income role, where all the dividends available ETF over here. Hedge role, we can hedge again the market, then we have gold ETF. If you need tactical, we have the KLCA 2 times leverage or 1 time inverse. And last but not least, our Malaysia core roles will be, for example, the core holding the KLCI. Okay, and this is very important. Just an example, no buy sell call, but just to give you guys a reference so that you get to expose to the ETF market available in Malaysia, in Bursa Malaysia, more effectively. And having said that, right, a portfolio resilience always comes from a more disciplined strategy. So avoid over concentration, like I mentioned just now. Review our ETF exposure when market conditions change. So we need to be aware of how the market react right now. So that's hence I asked you guys, at the early of my webinar, ask what do you think is our current market condition? Because we need to be always updated, with the market change and rebalance based on strategy, but not emotion. Okay, and keep our portfolio goals, time frame, and so our risk tolerance visible. Today, because of the limiting time, I don't have more, time to share with you how to set your goals, how to review it together with the time frame and the risk tolerance that we have, But I hope that today's sharing we get to learn more about the ETF strategy that are available in Malaysia and how are we going to structure it with a core satellite approach. And last but not least, I would like to share with you some of the common ETF mistakes in the changing markets. First of all, a lot of investors will chase performance at the later stage, which you might chase in during the market, when they are picking. So please don't do that when you are investing into the market, right? Don't always chase the profit. And secondly, they're treating all the ETF the same. And like I mentioned just now, I've categorized it for you so that you will treat them differently for different roles and market conditions, right? And don't ignore the portfolio fit because you need to always, review your portfolio to make sure that they are not contradicting or they are not duplicating themselves. We need to always have this kind of review process because you don't want to have the mindset that, oh, I'm diversifying my investment portfolio, but ended up all the holdings that you have is the same. You don't want to have that thing happen in your investment portfolio. And don't overreacting to short-term volatility. And a lot of investors, they make this mistake is that they don't have a clear review or rebalancing framework. And with today's sharing, I hope that you get to have a strategy, on how to review and rebalance your framework with the core and satellite framework as well. Now, this is very important. Well, I understand we don't have much time. Let me try going through one of the case scenario here. So I can make sure that everybody here, you get what I wanted to share today, right? Let's give you a position. Let's do this case study together, guys, right? Let's position in a bullish environment. Assume that we have investors, okay, and his objective is a moderate growth over a 5 to 7 years horizon, okay, and now his ETF thought process is to use ETF for broader participation. He wanted to participate in the market without over concentrated in single stock, and current market is broad market trend improving, and the sentiments are turning positive. Now, in this market setup, okay, if these investors, okay, want to have a ETF portfolio using the core satellite approach, what do you think is his core participation, the core holding? What is that? I want the ETF code that we have on. Just name me one or two of the ETF available in Bursa Malaysia. What do you think for this investor? In his case study that he wanted to invest for over 5 to 7 years long term, what is his core holding that he can choose to invest for his investment portfolio? Anyone? Okay, FBM KLCI EA. Okay, wow, even have the code name, right? Okay, I think that's very simple, right? Like I mentioned just now, KLCI. Okay, now if we are at this current market condition, bullish market, and he wanted to have a selective satellite approach, on the growth towards broader market, what are the ETFs that he can choose to include in his investment portfolio? Just give me some example here. If you are this investor and this is your own case study, what will you do, to have a satellite approach on the growth? You want to participate more in the growth without too concentrated into a market, and you wanted to have broader participation. Anyone have you have the idea or answers in mind? Okay. Right. Okay. Let me give you some of the example you can use, right? If you are going to have a more growth strategy, then you can choose maybe China, okay, the US, okay. Not too much towards the gold, because when the market is moving bullish, gold tend not to move along too well, right? This is with traditional traditional economics theory, but current market apparently this thing doesn't work very well. And if this investor want to have some little portion into tactical, what is the ETF that he can consider? Okay, if you want to have more tactical approach, in his satellite holdings, what is the one? There's only one that he can use to consider, that he can consider to include in his satellite holdings. What is the one tactical holdings that he can have? Anyone have the answer? Okay, not the inverse, because the market, remember, because the market is in bullish, you don't want to have the inverse ready, then that will make you losses. So if he wanted to have a tactical play, in this portfolio, in this bullish market, he can consider the 2 times leverage. Yes, right. But be aware that this kind of leverage and inverse ETF, they are riskier. Okay, and because they are leverage products. Okay, so you get 2 times leverage up, you also get 2 times leverage down. So remember to always include this thing only in your tactical play. Don't have too high exposure to leverage and also inverse ETF. Okay. Now I believe with this case study, you guys have learned a lot, on the strategy on how to use and to structure your portfolio. And I believe you guys can also have more exposure towards the selections of ETF available in Bursa Malaysia. So I'm skipping my case study 2, and here come my final takeaway for you guys, right? So ETF are just tools, not a shortcut to investment, not the magic key to unlock your wealth. okay? But they are just tools, and use it wise, right? And different market condition will shapes our different ETF strategy. So always remember to study the market and study the strategy that you can use during different conditions. And portfolio fit matters. So always select the right and the ETF. Okay, depends on your goal, your time frame, the risk tolerance, and most importantly, to follow the market condition. And last but not least, discipline beats prediction. Always review, rebalance, and stay structured to your investment portfolio. And my final message to you guys is here: Malaysian ETF can be used more effectively when we think in terms of market condition, portfolio, discipline review. We need to have overall thinking and mindset towards selecting and structure our portfolio. So this is very important. So with that being said, I think that's for my sharing, and we might have time to move into some of the Q&A. And I hope that you guys learned a lot today. All right, thanks.
Alright, thank you Mr. Judge Paul for his wonderful sharing with us. We now proceed to the Q&A session. So if you have any question, please type your question in the Q&A box, okay? For the first question is, would you consider investing in ETF by using DCA strategy irrespective of market condition?
Well, thank you for the question, David. Right. So first of all, yes, we can consider investing in ETF using a DCA strategy. What is DCA? Okay, to a lot of people here, DCA means dollar cost averaging. That means that you can, go into the market every month by quarterly basis or on biannual basis, to go into the market, to average up or average down your cost of entering the market, but not to say that we don't need to look at the market condition. Now, why do I say so? Because in different market condition, you might work differently. For example, and to set things clear, right? To set the foundation, you can use this DCA strategy in your ETF in the core strategy. Okay, like I mentioned just now, we have core and satellite, right? So in the core one, yes, you can use it, right? But not irrespective of the market condition, because in different market condition, you still have to do things differently. So for example, if the market is in bullish trend, okay, then your dollar cost averaging will tend to average up because the market is moving up. So at this moment of time, you can consider, do your dollar cost by fixing the amount. Okay, for example, you say, okay, I want to invest into this KLCI ETF every month 500 ringgit. Okay, then you average up. But during the bear market, because the market is dropping, now you can also consider, hey, I don't want to only invest 500 ringgit every month. So how you can do? You can increase your amount of capital to invest into. Maybe you say, okay, I want to invest more, 600 ringgit, 700 ringgit, 800 ringgit every month, because I want to average down my costing. So here's the strategy, and there's no fixed rules that, okay, you need to do a DCA throughout the market, no matter it is up or down. But you can have this kind of flexibility, when it comes to different market conditions, and to make sure that you invest and you get your cost as low as possible, so that you get to enjoy the capital appreciation across the 5-10 years investment journey. Okay.
Okay, so we hope we have answered your question. For the next question is, when we buy foreign ETF like US ETF, we are also exposed to the currency exchange rate. So what exchange rate do Bursa follow? Whether the exchange rate is favorable to investor or not?
Okay, now because we are trading in Bursa Malaysia, so the currency that you are investing is definitely in Ringgit Malaysia. So you won't get to invest using US dollar in your Bursa Malaysia ETF, right? No matter they are invest into the US market, China market, you still use Ringgit Malaysia to trade.
Okay, so for the next question, which Malaysia ETF are considered the most resilient during inflation or high interest rate environment?
Okay, interesting. Now, Okay, let me ask you a question, right? What do you think is the market condition like when the inflation is high? Okay, sorry, just now the question was investment. The inflation is high and also high interest rate, right?
Yes.
Okay, so what do you think is is the market condition like when the inflation is high and the interest rate is high? Okay, so before you answer, okay, let me also give you some example. If the market is in a high interest rate environment, okay, what products or what investment tools tend to move the same way as the interest rate? Maybe you can say, oh, bond might move towards the same directions. A dividend, because if the dividend is not moving up, then investors tend to move or shift their investment portfolio. So to stay more resilient during these kind of market conditions, okay, maybe a fixed income ETF may work well, for you. So come back to the question, how do we get this kind of answer whether, which ETF, or which investment tools tend to be more resilient in different market conditions? We have to study the market. Because, for example, we study the cause of why we are in a high inflation and high interest rate environment. Why? Looking at the root cause of the market right now. And from there, you will monitor and you will observe, okay, what are the investment tools, that works well in this market condition and what are not. Then from there, you can go back to the basket of ETF available and select the one that is favorable for that market condition, right? And I think this kind of a strategy and mindset will help you throughout different kind of a market situation and environment, right?
Alright, we hope we have answered your question. So for the next question is, are Malaysia ETF really profitable? Because always been told that they are really slow and the ETF are illiquid.
Okay, now when we talk about the ETF profitable or not, like I mentioned just now, ETF is just a tool, right? And what's underlying it is more important than the tool itself. So as an investors, we don't come in and say, oh no, ETF is not profitable. Then you don't look at the ETF at all. Like I mentioned just now, I have categorized it for you. We have growth strategy, we have core strategy, we have tactical strategy, we have fixed income strategy. So in different market conditions, all these ETF work differently. In the bull market, maybe you will see the tactical play, the 2-time leverage will tend to move better. During bear market, you will see, why the others are not, performing while the inverse ETF, the KLCI 1-time inverse works well. So come back to the question, right? We don't say the entire ETF is not profitable, but to look at what are the suitable, ETF for that specific market condition. And with that, you can start to monitor back and observe back how the Malaysia Bursa ETF works in different market conditions. And there you get to experience and you will get the answer whether this ETF is profitable or not, right? And I hope that answer your question.
Okay, next question. Do you think stock technical analysis method and indicators are suitable for ETF and unit trust as well?
Okay, yes and no. Yes and no. Okay. I'm not a technical analysis guy. I'm more towards value investing and I study macroeconomics. For me, in investment, I tend to use the macroeconomics viewpoint to study whether the market is going bull or the market is going bear. But having said so, right, technical analysis is also one of the very important tools that we cannot ignore. For example, if from my economics study, I think that, okay, the market is going bull for the next 1 year, for example. But if the candlestick tell me the other way around, then it's actually giving me a signal on the current market condition that might not reflect what is going to happen in the next 6 to 12 months. And from there, I know how to position my strategy, because if the market is going downwards, well, my view is that the market is going up in the next 6 to 12 months. That's give me opportunities to collect and to enter with a lower cost at this time. So you ask me, is technical analysis important in ETF, unit trust, stock? Yes, it is, but the fundamental to it is always come back to the macroeconomic viewpoint and also the fundamental, of the investment. And we use technical analysis to complement our decision making, right? And I hope that give you some insights on how you can actually do the strategy yourself.
Okay, next question. Based on your investment knowledge, is it difficult to invest in ETF due to more things to study? What if invest in single stock is more easier compared to ETF?
Oh, I can tell you, invest in ETF is better than invest in a single stock. Why I say so, right? Well, like I mentioned just now, ETF, you only need to study the market itself. So for example, a KLCI index ETF, you only need to study how overall Malaysia market will move. And that will be represented by our KLCI top 30 index stocks, right? For example, or you can choose your China or US whatsoever. If you think that the macroeconomics is favorable for, let's say, US market or the China market, right? But to study a single stock is totally different skill set that you need to have. And I would say it's additional skill set that you need to acquire before you go and invest into a single stock. Why I say so? Because imagine if you are studying Maybank compared to studying a Petronas, these are two different industry, two different set of accounting studies, in how they works for their business model. And for you as an investor to study these two companies, it might take you about 3 months, 6 months to study well on why banks work this way in the accounting, and why oil and gas company, like for example Petronas, work this way in the accounting, in the financial. And that will take you more time and require even different skill sets, to master. So for me, ETF is easier and it's actually beginner friendly compared to single stock. And my advice here to beginners, if you are, okay, always start with macroeconomic studies first. And with that macroeconomic study, you can start monitoring, observing how ETF works. And while using that to structure your portfolio, you can start learning how to study and also how to analyze on single stocks. Then it gives you, exposure to the market while not overexposed to the single stock risk where you don't really know about it, right? So that's more important.
Alright, due to time constraint, we pick one more question. Okay.
Yep.
So, during volatile market condition, is it better to use a passive ETF holding strategy or active trading strategy?
Okay, during volatile market, my answer to you will be to be more active in the market while staying passively. Okay, why do I say so? You might think, oh, George is too confusing. What active and passive, right? Because the market is volatile. So our core we always need to keep it passive, right? And we don't overtrade during a volatile market because the market is moving very fast, tremendously fast, right? So you don't overreact. But why do I say you need to always be active? Because we need to always monitor and review our portfolio if the trend change, So for example, if you are using, for example, the leverage ETF during the volatile market, I would say no. Better better stay out of it because the market is too volatile. But if let's say you have a core strategy where you invest into the KLCI, then keep on investing it passively during this market, and you need to weather through this entire volatile market and until a clear signal showing that the market is moving upwards or downwards, then you can start to start to be active, in your portfolio selections again, when the market take their side, right?
Okay, we hope we have answered your question. We would like to sincerely thank Mr. George for taking time to answer all the questions.